Meanwhile, American Express has reported second quarter results today before the opening bell. Those results exceeded expectations and highlighted how the credit card's focus on wealthy customers has helped it remain resilient in a tough consumer environment. To talk about the latest Amex results and the stock, let's welcome Moshe Orenbuch, Managing Director and Equity Research Analyst at TD Securities. Moshe, thanks a lot for joining us. The takeaway here that I see on Bloomberg is that affluent customers were a big part of the story in the quarter. How typical is that for Amex?
Yeah. Well, thanks for having me, Paul. And yeah, that is the typical story for Amex. They're predominantly aimed at the affluent consumer. Those consumers have continued to spend. That spend didn't accelerate, but nor did it decelerate. So it's been strong.
What about costs? Bloomberg reports that the firm made risk management investments for its affluent customers. What is being referred to there?
Right. So I think that to support its overall growth, their operating expenses were up about 9%, which is a little higher than historical. They did say they were hoping or expecting that would tail down to closer to the mid-single digits for the full year, but that was something they did call out specifically.
It's a very, very different company than Visa or MasterCard. It's not a payment processor. It's actually a lender to its customers. How should investors think about this stock and this company?
Right. So American Express is both a network and a lender. So it isn't just a network like Visa and MasterCard or kind of just a lender like some of the others. But it does have a very strong positioning within the premium segment. It's an area that's had gotten a lot of attention lately because some of the other large financial institutions have also kind of taken, kind of drawn a bead on that sector as well. You've seen, some, Chase Bank do that with the relaunch of their Sapphire Reserve card, and some other banks have done that in recent weeks and months as well.
What's in it for an affluent customer who signs on for one of these elite these elite cards, be it an Amex card or a card from another issue that comes with a fee of $500, $600, $700 a year? What are they getting for that
Yes.
for that fee, and why perhaps psychologically are they attracted to that offering?
Right. So first off, the fees have been increasing, and they're now kind of increasing to the above 500 level for the most premium of those accounts, and some as high as 800 and possibly more. They do come with benefits. Some of those benefits are psychological in terms of being part of a somewhat elite club, but they're also tangible in terms of access to lounges, rewards on types of spending. And then also each of those companies generally has partnerships with other merchants who want access to that high-end customer base who kind of give rewards, whether it's a hotel chain or whether it's, Uber or Lyft, that provide benefits in order to induce those high-spending customers to be using those services as well.
That sounds like a business that is resilient to ups and downs of economic trends. Is that fair to say?
I mean, it's definitely somewhat resilient. I think, all people are, kind of need a job in order to continue to spend the way they were. And so fortunately, the U.S. economy still has a very strong level of employment. And so they've been beneficiaries there. What
kind of guidance did Amex provide?
So Amex maintained its guidance for, that they had before, which is, 8 to 10% revenue growth and $15 to $15.50 in EPS for the full year. So they didn't really change their guidance at all. The beat in the quarter was small and focused, we think, in both the loan loss provision and tax line. So most of the other areas were kind of in line with our expectations.
You have a hold rating on the stock and a price target of $320 per share. Why the hold, and what kind of valuation metrics do you use to arrive at 320?
Yeah, I mean, it's Amex sells at a higher multiple than other card issuers, and that's because it does enjoy very, very high returns. I think what our hold rating is a function of both that strong valuation that it's got right now and the fact that things are kind of in a holding pattern with respect to spending to some degree because of the nature of where we are in the environment. Is that spending is not significantly accelerating here, and so you've got kind of a holding pattern.
I see from my Bloomberg screen that within your coverage universe, you have a buy rating on Capital One Financial. That is a card issuer on the other end of the spectrum, I believe. It is the low interest rate issuer of cards, correct? Why don't we finish with your thoughts on Capital One?
Sure. So Capital One is actually has both, it is a competitor to Amex as well, although a more recent one. In terms of, for the high-end kind of spender, but also does have both through its acquisition of Discover, kind of a big, kind of, you call it mass market, not in a pejorative way, as well as a non-prime credit card business. So it is a full-spectrum credit card lender. I think the difference there is, number one, the valuation is lower, and number two, I think you've got a better kind of growth trajectory in the coming months and quarters because of some of the things they can do to leverage their recent acquisition of Discover.